I know last time, Perry, when we were talking, there were a ton of interest in your spreadsheet.
Yeah,
And you were gracious enough to actually share it with us on the screen, and you walked us through different tabs of it and whatnot. We chatted a little bit before, of course, before the call was like, and you were mentioning that it is complex. You've put a ton of effort and
yeah,
time into building it, and I think we chatted that you might be interested in future perhaps share some of the specifics of it in a separate video. But for
yeah.
today, well, don't be if you're open to it, maybe share some of the core
Sure,
metrics that you use more often, like the ones that you go through. I think that
sure.
would still be of interest for our folks.
Okay, so this is just one tab of my spreadsheet. And again, when I said that my spreadsheet's large, my spreadsheet is very large, very complex. If you look at the very bottom here, I think you can see my mouse moving, can you?
Yeah, I can. Yeah.
Okay, good. So if you look at along the bottom, these are all the tabs that make up my spreadsheet. So there's my ETF meta, which is basically the spreadsheet that talks all about the ETFs that I am interested in. So the one thing, just so you know, Mo, I don't sort of keep all the ETFs in the world in my head. When it's, I have a catalog of ETFs that I believe in enough, or I'm convinced in enough, that I'm going to always invest in them, or I'm going to invest in them for at least this period of time. So that list is basically what my ETF meta chart holds, and it basically keeps track of my price, its value, all its distributions, all its price things, price trends. So that this one over here is what basically tells all my other tabs what's going on. Okay.
Yeah.
Now, with that being said, if I go to my portfolio, this is my general portfolio. So this is the aggregation of all 7 of my accounts.
Yeah.
Yeah, so this one basically says, what are all my accounts doing as a whole? If you look at each one of them, every one of them is one of my accounts. So they'll look the same. If you can notice, they all look the same, right? But each one of these tabs is tracking what that account is doing. So this is my RIF. This is my wife's RIF. This is my LIF. This is my PRIF. The only one that is very unusual is my non-registered, because all it holds is my stocks, so it doesn't look like any of the others combined. And then there's my 2 TFSAs. There's my TFSAs and my wife's TFSA. Okay? So their job is basically to track the income and the performance and the movements of each one of my accounts. My portfolio tab aggregates them all together and says, here's what all 7 of your accounts are doing together. Okay? Now, if you look over here, you can see that basically here are my 3 growth stocks. That's why they say G1, 2, and 3. And then all the rest of them are the ETFs that I hold in at least one of my accounts. I mean, some of them may not have them. Like if you looked at my TFSA, you can see that my TFSA doesn't have a lot of them. A lot of them are not being used. You can see they're empty here, right? Because in my TFSA, I don't buy all of them. I only buy the higher yielding ones. So, but if you go to my portfolio, it shows all of them because at least 1 or 2 of the accounts holds it. Okay. This stuff basically tells me my book cost. This shows me my current pricing. What's important here as a metric is this one here, because we talk about erosion. Like the reason I track this, I track it for a 6-month price trend. I'm looking here, again, this is an important one for my eyes to see every once in a while. If you can see the little red dots and the little green dots, do you see them?
Yeah.
The red dots are sort of saying that's the low over the last 6 months. The green dots shows that's the high over the last 6 months. The only one that worries me here, if you could see that stands out, is this one here. Remember HPYT?
Yeah.
That I told you was one of my losers. Again, losers, but it still pays me yield. And my other one that's a loser is USOY in my oil. So this one's showing me here that there is a sort of a sign of erosion here. This one, HPYT is not erosion. It's just that the bond markets are terrible. So so that's just basically the underlying's not doing good. But with USOY, I think it's a mixture of both. The oil pricing is not that great. It's up and down a lot. And basically, I think there's a little bit of erosion here. So if you have to say there's one that has erosion, I would say this one might have a little bit of erosion, but it's actually, I think them switching to weekly and stuff might hopefully hold it in place. Again, not too worried about it other than the fact that I wish they would start either staying stable or going up. Okay. So it's important, Mo, to know here, this is the one that watches for things to see how stable the NAV is going. on the thing. If I go a little bit further over, like that's my price. So this one here tells me the latest income that's happening on all my ETFs. I do a 6-month trend on all my distributions. So I want to know on a monthly basis how each of my ETFs distributions are looking. So you can see here, for example, I'll pick anyone. So here's a good example, HHIS, which is everyone's darling right now. And actually, yeah, it's a darling of mine. You can see right here, steady as a rock, boring as hell, because basically every month it pays the same amount. Okay. The other two that have always done really good, but their yields are lower, is Hamilton's HYLD and HDIV. If nothing else, their distributions actually go up a little bit. Not by much, but they go up. So these are all, one thing you do notice for the most part, and a couple of the Canadian ones have changed since January. Like ENCL was a darling, but they've actually had some drops in their monthly distribution. But generally speaking, if anyone wants to have a very stable, conservative covered call ETF strategy and doesn't want to take as much risk, just buy a lot of the Canadian ETFs, because they're so boring in the sense, in a good way, and I'm not saying that bad. They're boring that every month I almost have to cut and paste last month's distribution and put it back in place. So
constantly changes. Pretty much
they rarely change. Yeah, like here's this one. A call and bank haven't changed. Matter of fact, bank has actually gone up, but call and bank have not changed generally all for the last 6 months. If I actually went back a year, it would show you the same thing. Like I'm only showing you 6 months, but in a year, they would basically show you the same thing. So if there's something to say about that, Mo, it's like if anybody wants to dip their toe into covered call ETFs and doesn't want to take a high risk, just buy a lot of Canadian covered call ETFs, because they generally are a lot more stable and pay a very consistent amount. Yeah. You can see down here on the other side, you can see it's going up and down. Like you can see the US ones. So the US ones are like every month. Yeah, every month you don't know what you're going to get. Like, you could be very volatile. They're very volatile. Now, that being said, they also pay higher yields. So, you can't have your cake and eat it. If you want conservative and stable, then you're going to get lower yields. If you want something that's a higher yield and pays you a lot more on a monthly basis, you're going to have to take the good with the bad, but those are the ones that are more volatile, right?
And I think we had talked a little bit about this as well. Like some of them probably use a different strategy, maybe even covered call on a larger portion of the fund. So that's
absolutely. That's how they maximize their yield. First of all, whereas you get the Canadian ones that don't write contracts on any more than 30 to 50% of their underlying, that means they can grow or stay more stable. They're also likely staying farther away on their strike price so that they actually win more of their contracts. Of course, the further you away from your strike price, the lower your premiums are going to be, right? Yeah. So these guys here, they're writing their contracts on pretty much the entire holding underlying. So one, it's harder for them to keep up on market rises. You'll see that they, like Coney has gone up a lot, but Coney has not gone up as much. And the reason is because they got contracts on their entire contracts, right? So, or on their entire underlying, right? So that being said, the Canadian ones are typically the only ones that hold leverage. And that's another nice thing about things like, MSTE, CNY, PLTE. They're all right. They actually have a 25% leverage, which actually gives them a boost that they normally couldn't do when they're so conservative, right? So that's the one thing. So this tells me what this circle, and I'll go over here. What this whole green area does is tell me everything about the yields on my ETFs. So for example, there's my yield on cost versus my yield 6-month average versus my current yield. So I always watch this one. This one's always interesting. So you can look at my USOI right now. There you go. You see, this is one of my biggest losers, but look at it. It's currently, even my yield on cost is 87%. Wow. Now, if I were to buy it today, it would be offering me 145% yield. Again, I only look at, this is the number that says how much is my yield. My yield on cost is how much I paid versus how much I'm getting.
Something that some of them that are over 100%, it always makes me think, would they be able to even sustain that? Like, is it because of those premiums and whatnot? Is that mainly because of that?
Yeah. Yeah, here's the one thing that's changed, and again, I'm seeing changes. You said what's some of the trend. You're going to ask me a question with regards on what are some of the exciting trends that you're seeing with covered call ETFs. One of the trends that I'm actually seeing quite a lot right now, and I think it's been there all along, the managers of these covered call ETFs are very responsive to customer demands. Something you wouldn't see on the old iShares or the big, BlackRocks, where they didn't really care what the customer is wanting. Here's what you got. If you don't like it, don't buy it. But what you're seeing with the covered call ETF managers like YieldMax, Defiance, Harvest and Hamilton, you're seeing that they're listening. They likely are even watching the Blossom community and stuff like that, but they're actually responding to it. Like YieldMax, the biggest scourge that YieldMax and Defiance had over the last year and a half was that there was a clear sign that they were showing erosion. I mean, IWMY, QQQY, I mean, they were showing erosion big time, but they have changed things. They've put in call protections and stuff like that. They're not being as aggressive anymore. Now, I have noticed that their yield has gone down. Like their yield has gone down quite a bit. They used to be at I'll use IWMY. It says its 6-month yield was 57%. It used to be over 100. They've dropped down to about 57% on a 6-month average. The reason is because they've really pulled back, in my opinion. Again, I'm not the expert here, but my opinion is they've noticed that they were getting a lot of bad press and people walking away from their ETFs because people said, you know what, I like high yields, but I like something a lot more stable. I don't want to see NAV erosion. So call a spade. And so I think they're responding to it. Matter of fact, QQQY, IWMY, and the other one, their S&P one, they've actually set now yield targets, I think, of 30%. Well, that means we're really going to see these yields coming down because they're going to be a lot less aggressive. But on the good part is they're doing it because customers are telling them, yeah, I like your yield, but I also like something a little bit more stable. So to me, that's an exciting thing to see about this component or this sector of the investment tools, is that these covered call ETF managers seem to be listening to their customers and responding for it. Harvest responded by putting their first single stock ETFs in Canada. Hamilton has responded by actually offering their first zero DTE ETFs. They're doing this because customers are willing to pay for it, and they're putting out a product that customers are asking for. So
very interesting.
Yeah. So the other thing in here is like this one and this one go together, Mo. So these are my income projections based on what my holdings are. So I do this on a 6-month average versus current as well. So if it's green, it means that the last one was better than the average. And if it's red, it means it's lower than the average. So this is telling me that if things don't change, this is what this ETF is going to provide me on a monthly basis. It'll provide me $2,000 a month. It used to be providing me $2,400 a month based on a 6-month average. So it's generally going down a little. This one here is going up a lot. So that's USOI. So again, the guy that's my biggest loser is actually going up in monthly distributions. So, and this tells me what my annual distribution would be on average, not on current. I use it on average.
Those average ones, the one that you showed us earlier, for how long, or they're averaged over 6 months?
Everything I do on my spreadsheet's on 6 months.
6 months. Okay.
Yeah. To me, after 6 months, the history, the things, 6 months is a long time for these covered call ETFs. So to me, if I see a trend in 6 months, that's good. I'm happy. Plus my spreadsheet gets too long if I had to try to track over a year. So this one here, I just actually posted on this one this week. This is what's called, I should actually call it house money, but this is the one that tells me on each ETF, how far am I away from actually paying back my entire investment? Okay. So basically this says, if I was on day one, if I bought this ETF on day one, how long would it take for me for Coney to pay me back? Well, it's currently saying that if I bought Coney today and just sat on it, it would take me 2.6 years for me to get all my money back in distributions. Okay. What it's telling me here is, yeah, but you've had it for a while and you've bought more, you've sold a little, but generally speaking, as of right now, across all 7 of my accounts, in less than 6 months, so 0.4 of a year, about 5 months, my Coney investments, if I don't buy or sell anything more, my Coney investments will be fully paid for, and I refer to that as house money, meaning that any distributions I get after that's fully paid off is pure profit because I basically paid for my entire investment. That's what they did. So this one's sort of saying what is it at a percentage level. So Coney right now is the closest to reaching house money at a portfolio level. It's at 83%, followed up by Misty, which is at 80%. And then these two here, these two ironically are the next ones at 63 and 67. And some of these are what I'm not going to go too much on this one, but these are my targets. Because remember I told you everything I do based on targets. So when I buy a new ETF, like I just bought Alti today. So I had to squeeze Alti in, which is a pain in the butt for my spreadsheet because this is why it's got a lot of care and feed. I have to actually insert a row for all my tabs to do this. So it's another reason I don't add new ETFs often because it's a major pain in the butt to do so. So this one here says, okay, well, I've got Alti now. So I had to actually make adjustments to all my targets to say, well, if Alti needs a holding weight, who's going to give up some, right? So I had to go through here and say, okay, well, this one here, I'm going to bring it down from 4% to say 3.5%, whatever. But you can see right now, I've set a target weight for Alti. He's my new ETF. So I'm saying I'd like to see Alti reach 2.5% as a target weight. If it's under, that's fine. It means I got some time. If I want to do some reinvesting, Mo, I could turn around and say, okay, I'm a little low here. I'm at 1.3. Alti's looking like it's a good deal because it's on sale this month. I'm going to buy, and here it tells me how many I need to reach target. So it's a little dark blue, so it's not easy to see. But it says you need another 1,936 units of Alti in order to reach your target of 2.5%.
Very cool. It even tells you, like, based on today's price or last price, this is how many more units of it you need.
Yeah, and if it's yellow, it means I'm over. So it's saying, hey, if you're overweighted and you want to get rid of something, you'd have to sell 600 units of HHIS to reach 7.5. So I'm actually high on HHIS. I really
you then tend to typically, Perry, assuming they are still meeting your criteria, tend to put some of the distribution that you get into the blue ones because those are the ones that are lacking the rates.
Absolutely. Yeah. The first thing I'll look at always is the blue ones, because if I have, say, $20,000 of money to reinvest, I'll look in here and say, okay, I don't care about the yellow ones because I'm overweighted in them already, so I won't buy them. So I'll only look at the blue ones right away. And then once I look at the blue ones, I'll say, okay, well, out of the blue ones, which one's either very underweighted or which one's on sale? So there's no science with regards to it, Mo. I'll turn around and say, wow, LFGY. Like it's one of my ETFs I really like. LFGY is down at 38. Let's say it's at $38 and normally it's at 40. I'm going to get, okay, I'm underweight and it's at a good price. I'm going to put my money towards buying more LFGY. So that's why I don't believe in drip. Like a lot of people say, do you do drip? I don't do drip because I want to manually decide where do I send my money. If you do drip, yeah, okay, it's easy. You walk away from it and it does all the work. But at the end of the day, you are missing out potentially on some good deals because you could be dripping on LFGY when it's on its 52-week high, right? So you miss out.
You have definitely much more control. Now, this is probably a nice segue, Perry, because I know there are a lot of folks that you did bring up as well some of the feedback that you heard in different questions. Like, how come Perry has this many variety of holdings? Like 27 right now, we talked about it. Isn't it over-diversified? What's your reaction to that?
Yeah, that's a very good question. And it's one I definitely want to address because I know there are some other very high influencers that don't believe in that. And again, there's nothing wrong with his strategy of actually saying I'm only going to focus on the indexes because they always are the winners. And I listen to him, and you know what? The very valid point on his point is that he only focuses on indexes and he doesn't focus on the high yielders because he gets more than enough than he wants from his 7 index. It keeps it simple. I tend to be wanting more yield. I want to focus on more yield. In order to have more yield and to go after the higher ultra yielders or the ones that are more risky and more volatile, you got to have more diversity. So I can go after the PLTYs and the ULTYs because I have a lot of very conservative ETFs that can hold down the base for me. So I'm not worried about having only 7 of them and one of them ends up being LFGY, or let's just say, PLTY or LT. LT is I'll call it a higher risker one because all the underlyings are very risky underlyings. So, somebody that only has 5 or 6 ETF holdings, they can't look at Alti. And the reason they can't look at Alti is because it's too risky when you only are holding 7 ETFs. Well, let's say 5 ETFs. That means you're basically putting 20% of your weight in every one in one of your holdings. When I have 27 holdings, I can basically say, yeah, I'll put some Alti in there, and it's only going to be 2.5% of my portfolio, and I can actually draw out 70 or 80% yield on that one. If it goes down the tank or drops down to like 40, 50% yield, well, I'm not losing much because it's only 1/27th of my entire portfolio. So the reason I believe in diversity is it gives me the option of going after the much higher ultra yielders that somebody that's only holding 5 or 6 ETFs can't do. They can't do that, or else they're really risking their portfolio to do it because they have to stick to conservative, safer ETFs. I don't have to do that because I have a lot more ETFs that cover my butt. That
was given your strategy that and your focus on much higher yielders. You use the higher number of ETFs as a way as well to essentially to diversify your holdings and kind of safeguard yourself better.
Exactly. Like I don't worry about it. If you look at it, there's a few of them. Like I'll pick one. So there's a couple of them that are pretty high. Like HHIS is up at 8% right now. That's big for me because my rule is not to hold any more than 5% of any one stock or one ETF. So this one's at 8.1%. The reason I'm letting it go is because HHIS, as it's in its own right, is an umbrella of underlyings. So I'm not as worried about that one. So I've accepted the rule that I can go beyond 5% on here because I've already said HHIS is holding 7 or 11 other ETFs. So it's actually 8.1% of 1/7 of 11 of 1/7 of the others. So that's why I'm not worried about that one. But I don't worry about it now. Like, let's just turn around and say something really happens and oil drops to 0 and USOI just disappears off the face of the earth. Well, I've only lost 1.7% of my entire portfolio. I was gaining 80%, 100% yields until it happened. The chances of that happening, Mo, is very, very, very low. But if it did happen, I wouldn't be hungry and living on the street. And people say there's a lot of overlap. That's another argument. Some of the people that say, well, Perry, you're not really diversified because you're overlapping. All of these are overlapping each other. They're overlapping in the underlyings, but they're not overlapping in their strategy, in who's running it. For example, just in covered call ETFs alone, there are so many different strategies that each ETF manager runs that the underlying is only one factor of diversification. And we already talked about it earlier, Mo. For example, Harvest and Hamilton and Evolve, their ETFs are very conservative. They basically only write contracts on 30 to 50% of their underlyings. So generally they're doing it. So when you say something like, well, look at Misty, Misty is using the same underlying as MSTE. Well, yeah, they are. But look at Misty. Misty basically writes contracts on all of their underlyings, and they're actually synthetics. And the other one, MSTE, is writing it on only 30 to 50%, and they're writing on native underlyings. So you can't just say that because they all hold the same underlyings that that's the only diversity you look at. You have to look at every kind of it, and the contract writing, and how much they're doing the moneyness, how close they're to the strike price. I like diversity on ETF managers because you don't know, maybe Harvest has some, I'm just arbitrarily using them, but Harvest has something bad and something goes wrong, like an Enron, and they go under. Well, if I put all my eggs in their basket, I would have went down with them, right? So again, I'm just using them arbitrarily. So sorry, Harvest.
Separating yourself from different angles. You
That's
see
right.
diversity not just in the underlying asset per se, but also that's one aspect of it. The other aspect of it is, for example, all the different strategies, different fund providers, and also that's why you look at so closely at a variety of metrics that you just shared with us as well.
Absolutely, yeah, and that's what I say, Mo. Like, again, this is my IT background. When I had to build large multi-country enterprise systems, when I was designing and architecting systems, you couldn't just say, yeah, we've got this high-speed link that connects our two head offices together and that's good enough. No, we had to look and make sure that we had, high availability, we had alternate paths, that we had disaster recovery, that we had to make sure that we were in compliance. So when I look at things, I look at every way that something could go wrong, because honestly, Mo, my portfolio is all my income, other than a little bit of CPP that comes in. If this portfolio goes, my family's income is gone, right? So in my opinion, this is as important to me as CN losing their main data center. Like, the scale is bigger, but at the end of the day, if I lose my portfolio or 50% of my portfolio because I invested it all on HHIS or MSTE, well, bad on me for putting all my eggs in one basket. So to me, I'd like to know that if an ETF goes, it's not going to hurt me more than 5% of my portfolio.
I really enjoyed the conversation. As always, thank you so much for coming to the show. Any final words before we end in this episode?
No, again, honored that you'd want to have me back for a second thing. I actually enjoyed it, Mo, because we didn't really get to talk a lot about the mechanical details in that. So it was good to actually have this second meeting where I can actually answer direct questions and get a little bit more into the, nitty gritty. So I appreciate that. And thank you very much for a great interview.